Goldman Sachs believes Brent crude will rebound and average $70 a barrel in 2019. And do you agree? And if so, how soon do you think it will happen?
So I think in terms of this question, I think it's important to identify the fact that among all of our peers on the sell side, Barclays was one of the most bearish as we moved into the fourth quarter of last year. Many of our peers had all been forecasting $100 prices, $95 prices as we moved into the fourth quarter, and we're expecting that into the next year. And we had maintained a bearish outlook into the fourth quarter, and now that the market has overshot that expectation, we've not really changed our expectation for next year. We have always maintained a $72 Brent forecast for next year, and we've held that view since July of 2018. So, in our view, we continue to see the fundamentals of this market being supported by the fact that the physical market is tightening, and refinery margins, so the incentive to produce refined products from crude oil, has actually in certain places has been weak, and in other places has still been strong. So as I mentioned at the outset, there are obviously risks to the view that prices will rebound, but based on our market balances and based on the resolve of the Saudis and the Russians, we continue to believe that this market will rebound, and it could even rebound sharply as we move into the first half of next year.
You wrote about U.S. House Chairman calls for anti-OPEC bill to become law this year. Do you think it will affect OPEC supply cuts and the oil prices?
So I think this is a really important question, and not a lot of people are talking about it. We've written about it a couple times in our research, and what it is, for those that don't know, is that the NOPEC legislation has been around for about 10 years, and it allows the Attorney General of the United States to, under the terms of the Sherman Antitrust Act, actually sanction, not really sanction, but bring about an issue for certain countries that are members of the OPEC and non-OPEC, essentially a cartel. And so that can result in prohibitions on investment. It can result in a whole host of different problems for those OPEC countries. Some would argue that that is why the Qataris left OPEC just in advance of the last OPEC meeting that happened in Vienna. But I think the stars have aligned more so now than almost ever before, because we have a U.S. president that has been on the record for over 10 years as against the OPEC cartel. We have a dynamic where prices could conceivably increase sharply as we move into the next year, which would create problems for U.S. consumers. And then we also have a dynamic in terms of Russia and Saudi Arabia, where the U.S. Congress is looking for a way to penalize both Russia for various reasons and the Saudis for the Khashoggi incident for their policies. And so from the U.S. congressional perspective, they're keen to use this NOPEC vehicle as a way to move forward, as a way to penalize the OPEC cartel. Now, whether or not that results in a different policy is still too soon to say, but it does create an additional point of leverage for the U.S. administration to use in a situation where the Iran sanctions tighten to a sufficient extent that it actually leads to higher prices.
U.S. Treasury Secretary says expects January trade talks with China. How will the talk potentially affect the commodity market?
So I think there's both direct and indirect ways that that these trade talks are having an impact on the commodities markets. Obviously, as we've seen over the last several weeks, that the gyrations in the macroeconomy have been in part sourced from concerns about trade tensions. How long will they endure? What is the nature of these trade tensions? And as a result, commodity markets have also fallen victim to those macroeconomic concerns. And so we've seen, mainly in the industrial metal space, the reduction in prices for copper, for iron ore in part, as a result of these trade tension issues. Going forward, we've already seen certain materials, for example, washing machines, soybeans that have either had a higher tariff associated with them or could fall victim to these trade tensions, see the prices impacted as a result. For the oil market specifically, if trade tensions result in a decline in macroeconomic expectations or a decline in GDP growth expectations, all of that will have an effect on oil prices and, for that matter, other commodities. It's easy, though, to say that there are certain commodities, such as copper, such as iron ore, that are tied more closely, and I should add oil to that too, but are tied more closely to the fate of the macroeconomy. And there are other commodities, for example, gold, that will arguably react in the opposite direction because of its specific dynamics. And there are other commodities as well, such as natural gas, that react for their own idiosyncratic reasons to the fundamentals of the market. And so some of those commodities will not be affected by the trade tensions.